Well, it was another strong week for risk assets last week. The S&P 500 rallying 20% from the low that we saw last October and now officially meeting the definition of a bull market once again. And that move came despite two, what the media at least are calling hawkish central bank surprises. But viewers of this show will know that neither Ryan or I were surprised by the 25 basis point hikes that we got from both the Reserve Bank of Australia and the Bank of Canada last week. It is an absolute monster of a week ahead. Plenty of event risk, central bank decisions due from the Fed, the ECB and the Bank of Japan, and a busy slate of macro data as well. The latest US inflation data's UK labour market report and plenty of other releases besides that. As always, it's another busy episode of the Trade-Off UK this week. So without further ado, let's get into the show. So, a ton of stuff for Ryan Littlestone and I to discuss this week. But before we get into that, given Ryan's outfit, I think Ryan Littlestone from Forex Flow Live and Forex Analytics is going to take a bit of a victory lap after what happened in Prague last week. Morning, Ryan.
Me take a victory lap?
What on earth is going on there?
What happened last week? I don't seem to remember, mate. Oh, yeah, we won something.
Where is Kyriakos and how much have you paid him to do that?
Yeah, I emailed him yesterday. Said, do me a little favour and I just want to change my background for this week.
Oh, dear. Right. Well, it seems like we'll have to put up with that for the rest of the show. So let's get into it, into Topical Thunder. It's 8:15 on a Monday morning, and that was quite a shock for me in my slightly sleep-deprived state this morning. Let's get on to hopefully more familiar ground, and we'll start the show with the Fed. It is obviously the main event this week, the FOMC decision, and after 500 basis points worth of hikes since March of last year, we are set to see a skip from the FOMC. It seems likely that the committee will vote to leave the target range for the Fed funds rate unchanged at 5 to 5.25% this week. It looks likely also that they will skip rather than outright end the tightening cycle. What we've heard from recent Fed speakers, including the incoming Vice Chair Jefferson, is that they will leave rates unchanged in June, but then perhaps hike again in July, which will give them a little bit more time to assess some of the data that's been coming in. Now, there is some debate, and I'm not entirely sure in the value of a 6-week-long pause. You're not really going to gauge much from one more inflation number and one more labour market number, but there we are. That seems to be the situation that the Fed have guided us towards and have almost boxed themselves into at this point. But of course, it's not just the rate decision that's in focus this week. The guidance is also going to be eyed, but that's likely to remain unchanged from what we saw in May, with that data-dependent tightening bias remaining. But we also get the Fed's latest summary of economic projections, their latest macro forecasts. And I think this is where the real interest lies, because not only do we have the dot plot, where the median dot for this year is probably going to be revised higher by 25 basis points to signal that skip and the likely move once again at the July meeting. But I think also some of the Fed's other economic forecasts are a little bit too pessimistic at the moment. If you look at unemployment, for example, yes, we saw unemployment rise to 3.7% in the month of May, but the Fed think that unemployment will rise to 4.5% by the end of the year. Now, for unemployment to rise 0.75% in 6 months, that's quite a significant and rapid deterioration in the labour market, which doesn't look especially likely to happen at this point. So I think the unemployment expectation will come a little bit lower. In terms of growth, that's also looking a bit too pessimistic. I think the Fed are forecasting growth of around 0.4% on an annualized basis this year. Well, the economy did much better than that in Q1. It's looking set to do better than that in Q2 as well. So we'll probably see that revised a little bit higher as well. I think the inflation numbers will remain largely unchanged from the Fed, core PCE and headline PCE to remain above the 2% target for the entire forecast horizon. But of course, speaking of inflation, I know we're going to get onto data in a second. That's the big risk here with the Fed, because as we sit here now, Monday morning, the Fed markets are pricing just a 1 in 3 chance that the Fed hike at this meeting. We've got the latest US CPI numbers out around about 18 hours before the Fed announced their policy decision. And I think bearing that in mind, and also bearing in mind how strong some of the incoming data has been, and I want to get your view on this, Ryan, of course, I think, in my view at least, as we saw with the RBA, as we saw with the BOC, and I would caution about drawing parallels from them, but I think the risks are probably tilted towards more of a hawkish move than more of a dovish one going into the Fed on Wednesday night.
Yeah, I agree with that. I think the market may be underpricing the Fed moving. It is a bit of a coin flip, this meeting, because we've got that CPI data the day before. If it comes in really strong, it's going to flip expectations very much to the hawkish side. So, yeah, this one, probably one of the closest meetings we've had for a long while in terms of the data coming beforehand. And I think perhaps the data could be more important for market moves than the FOMC itself, because, as I say, if it is strong, the market is going to move as if the Fed's going to hike on Wednesday and do half the work of it that we would get on Wednesday anyway. So, but on the other side, if the data comes in really soft, it's going to cement those pause expectations. And again, the FOMC will probably be quite a boring meeting because they'll pause and, like you say, indicate they're not yet done. But I think that the important things, there's two important things to look at. Obviously, the announcement, but the other thing is the dots. And I think it's the dots for 2024, 2025 that are going to be the most important. I don't see any real changes around the 2023 dots. I certainly don't think anyone's going to be lowering their dots because they want to keep the expectation in that, not give a sniff to the pivots, if you like, that they're going to cut anytime soon. But it's going to be those 2024 dots, whether they stay elevated where they are, whether they just move up a little bit. And that's one way that the Fed can give a message of this higher for longer so that the market doesn't get too dovish and start pricing cuts heavily, keep those dots high. So I think that's one of the big things to look out for in there.
Absolutely. I think just on the dots, it's important to remember that for the 2023 dot, at very least, it only takes three policymakers to move their expectation higher for that median dot to rise. And it is, of course, the median that everyone focuses on, given that all of the dots are anonymous. I take issue with you saying the Fed could be boring. These things are never boring, Ryan. Come on, we all love them. But I do want to ask you a question. I'm going to steal this from Mr. Blake Morrow because I'm doing an interview with him tomorrow, and I know that he will ask me this. We've got a massive week ahead, US inflation, Fed, ECB, BOJ, everything else, and I'll answer this myself again in a second. What do you think out of all of those has the potential to cause the biggest market volatility?
Oof. I think the Fed, as I say, is going to cause a lot because we've got this big data. The ECB, we pretty much know what's coming. We're going to talk about that in a moment. The Bank of Japan is maybe the one that might be a bit of an outlier because we might get a further movement towards a plan of exit. I'm not expecting any policy changes. There's probably an outside chance they may tinker with YCC, but I think they might just give a further indication of moving out of easing. And if it's strong enough comments, that could be a big mover for the yen.
Yeah, I would entirely agree with that. And I think dollar yen downside towards the back end of the week could be something worth looking at because, as you say, and as we've said hundreds of times on this show, the subtle shifts from the BOJ are when the market is not expecting it. And the market isn't pricing anything for the BOJ this meeting. Dollar yen vols are still on the floor as well. That is when you can see those big moves in the market on the back of a BOJ decision. So definitely one to watch there. But what about the other data that we've got coming out? So I've slightly stolen your thunder there, I think.
Yeah, as usual. Well, this is something we've been talking about over the last few shows and months, and it's this growing divergence between the data points or the sectors within economies. And there's no time to relax this week because no sooner have we finished with the FOMC, we start to get the 1st of the June US manufacturing data. That kicks off with the Empire report and Philly Fed on Thursday. So we're right back into the data zone regarding what happens at the July FOMC. So the Empire's been a bit hit and miss lately. It's the first manufacturing data of the month, so it's a bit of a bellwether for what's coming from obviously the PMIs and the ISMs. The last three readings, it was down minus 24.6, up 10.8, down 31.8. So it's not really giving you any real clues month to month, but the general trend, however, has been down. So we've been below zero more than we've been above it over the last few months, or probably the last year or so. And it's a trend, as I say, we've been monitoring quite some time, this divergence between manufacturing and services. We've seen it in the PMIs. But the problem is manufacturing is becoming more and more overtaken by services. So it's having less of an economic impact. You know, take the UK, manufacturing accounts for some 12 to 15% of the economy. And that's shrinking around the globe, really. Services really picking up the baton for where economic growth is. And they've been holding up much better. Now, as I said, we've got an FOMC again in July, so we haven't got long between the two meetings. So the data is going to be traded straight after this FOMC for the next FOMC. Now, there's some open questions on policy, if there are, from the FOMC regarding, are they pausing, are they going to hike again? This data may help answer those questions and indeed set some moves off in the day after the FOMC too. So we could get a bit of a flip-flop. They might pause and sound dovish. We get strong data, those expectations flip again. And that's what we're going to be trading for the next few months, these little moves in between meetings and what happens on the data.
Yeah, absolutely. And of course, it's not just US data that we've got coming out this week. There's plenty going on elsewhere. I mean, I think by the time this show comes out, we'll have had the April UK employment data, but we've also got employment data due out from Australia a little bit later on in the week. We've got April's GDP figure from the UK. We've got a final Eurozone inflation print due on Friday. And I think China still owe us some of the credit and lending data that was meant to be out last week, but at least as far as I can see, it didn't seem to appear anywhere. Although they did have some trade data out, and that was rather soggy, and another sign of the Chinese reopening recovery story just not really being able to take off at the moment. So, yeah, I absolutely agree with you. And I think it's important that as central banks get to the end of their tightening cycles or pause or look to pause, data takes on a much, much more important role. And of course, not just inflation. We've been laser focused on inflation data for the last 18 months or so. Now, as you rightly say, Ryan, we're starting to look at activity gauges. We're starting to look at the labour market in a lot more detail, because it's these metrics that central banks are going to be paying very, very close attention to when they're having their policy discussions around, do they pause, do they hike again, do they look to perhaps even ease at some point in the early part of next year, perhaps. This is the stuff that they're going to be looking at. And we know markets are forward looking, we know markets discount the future, and as a result of that, markets will be looking at all of this data that we've got coming in. And as you say, there's no time to relax this week. It's one data point after another, bang, bang, bang. And looking at that and looking at how that feeds into policy expectations for Q4 this year, Q1 next year.
Yeah, exactly. It's all going to be important. And, you know, as we've again been talking about previously, the next phase of all this is pricing in the cuts. And that's going to be very data dependent, because all the central banks will be getting their rates down to neutral at some point, or they hope to anyway.
No, absolutely. And certainly, speaking of the UK, I don't think we're anywhere near, or we shouldn't be anywhere near, cutting rates. I've got another anecdotal inflation example this morning. This cup of coffee, that may break the green screen. Oh, it has. Good. Up 5.9% in a week. The BOE need to really get a grip on this. Come on, it's going to, all the city workers are not going to be able to afford their flat whites if this goes on much longer.
Is that a little hint to Westy to give you a pay rise?
He is here this week. Wink, wink, nudge, nudge. Anyway, what is also happening on Thursday is not just His Royal Highness's visit to Trader X Towers. It is also the ECB meeting over in Frankfurt in their own tower. I reckon this one is a little bit easier to call than the Fed, to be honest with you, although obviously the ECB can surprise. They have had the tendency to do so before, either via Lagarde with one of her classic communications shambles in the press conference, or even the sources reports that we get sometimes during the press conference, but usually around about 4 or 5 o'clock London time, we get a deluge of reports about what actually happened in terms of the Governing Council's deliberations. But as we touched on earlier, I think the ECB is pretty straightforward. They're going to raise rates by 25 basis points. That would take the deposit rate to 3.5%, which I think is the highest since 2001, although I'm sure someone will correct me in the comment section if that is wrong. And they're going to retain their relatively hawkish bias and indicate that another such increase is coming in July. And actually, I've been surprised how hawkish some of the recent commentary from ECB members has been, particularly with both headline and, more importantly, core inflation starting to roll over. Lagarde coming out, I think it was early last week or maybe later the week before, saying that there is no sign of underlying inflation having peaked. That's really quite aggressive. And I think it implies that the ECB are going to hike at least twice more. The market is fully pricing in a rate hike this week. It's pricing in about an 85% chance that the ECB raise rates again at the July meeting, although I don't think we're going to see a commitment to raise rates beyond that, particularly as, and this is a problem that, of course, we're grappling with here in the UK. Policymakers in Frankfurt are now going to have to grapple with economic stagnation as well, both Germany and the Eurozone as a whole falling into technical recession over the winter. So I'd be interested to see how that changes and whether that sparks a bit of a downward revision to the ECB's growth expectations, because they're giving us new forecasts as well. But I think the key thing to watch, and it is quite a nerdy, geeky thing to watch, is what the ECB say in terms of inflation. Is the CPI, the HICP rate, forecast above 2% all the way through to the end of the forecast horizon once more? If it is, that's pretty much as you were. If it's not, if they now see inflation coming below target by the end of 2025, then you'd obviously expect the market to interpret that as more of a dovish move and downside risks to the euro as a result, I'd argue.
Yeah, I mean, I think we're nailed on for 2 more hikes. I think there's been enough noise around that to say we're going to get 2. You're right about the forecast. It's all about when they see inflation coming down to target. But, you know, we know what central banks are like at predicting well into the future. We've got the RBA as the case. They weren't expected to raise rates until 2024. And here they are surprising us with extra hikes. So, yeah, I think the conversation is going to move to about this September hike. Are they going to go again in September, or are we going to get 2 more and done? Now, we know that Lagarde got told off for pre-committing to those 3 hikes we had early in the year. So there may be language that takes a bit of hawkishness out of things regarding July. But as you say, we're probably nailed on for a hike this month, probably July, and then the argument's going to start around whether we go again in September, or whether they look to do like we're talking about the FOMC, where they hike July and say, well, we may pause and then hike later in the year. So, you know what they're like in Europe. They just want to get to their holiday period and then kick the can and come back after all they've been, Lagarde's been suntanning in Saint-Tropez, and then they come back and do it all again.
Oh, because she really needs that, doesn't she? I think the September ECB discussion is an interesting one. I mean, personally, I can see them almost fudging it. They would call it a compromise, but it's going to be a fudge, where they'd probably leave rates unchanged, but just quicken the pace of balance sheet rundown with the asset purchase program. The APP reinvestments, actually, the reinvestment of those is going to halt in July. So that is going to be then a topic for September. What do we do? Do we just let the balance sheet run down naturally? How quickly do we do that? Do they do what the BOE are doing, which is actually selling some of their asset holdings into the market? I think that's unlikely, but it would be very, very hawkish if so. And I think that would be one of those where the hawks on the governing council are happy because the balance sheet is running down faster than it previously would have done, and that will engineer some degree of tighter financial conditions. But at the same time, the doves on the governing council can go, well, we're happy too, because rates aren't going up anymore. And that will, when you've got, what is it now, 27, 28 people trying to make monetary policy, you're never going to get all of them to agree. And I think that would be perhaps the best compromise that they could find when you look into the third quarter of the year.
Yeah, so one of the questions I'd ask you, Michael, is do you think they'll be mindful about the potential divergence between them and the Fed? You know, let's say the ECB get to 4% and that's their pause level. If the Fed are on 5, 5.5, you know, that sort of area, maybe nearer 6, is that going to play into their deliberations? Are they going to want to keep that gap? Is it a problem to have that rates gap between the two economies?
Well, it's a good question. They will never say publicly that that is a problem, of course, and they will always say that they make policy dependent on their domestic economy rather than what any other central bank is doing. I think for me, the way that I tend to view things like that is, what does it do to the currency? Because that's really the way that you would feel the effects of that. If it weakens your currency significantly, you're obviously going to import a boatload more inflation, which is the last thing any central banker wants to be doing at this point. And I think on that, it's important to recognize that the ECB don't look at euro dollar. What the ECB look at is their own trade weighted euro index. And rather helpfully, they publish this on their website. You can also get it on Bloomberg, Reuters, probably TradingView, whatever platform you're using. And actually, even though the developments we've seen since March, trade weighted euro has basically gone nowhere, even though euro dollar is down 4% or so. So I think the only time you would see policymakers concerned about that potential divergence is if we saw the common currency weaken on more of a trade weighted basis because of that divergence. That's when you might start to see policymakers think twice. But by and large, I think certainly publicly, they're going to refute the fact that that comes into their discussions.
Yeah, and just quickly before we move on, it's something that traders need to be aware of. If we then come to the point where rates are going to start getting cut to a neutral level, let's call it 2.5% is going to be the central bank neutral level. You know, if the Fed are at 5.5%, that's 300 basis points of cuts they've got to make. If the ECB are at 4%, that's 150 basis points of cuts. So there's going to be a divergence play for the euro dollar in between how much the Fed and how much the ECB are going to be cutting.
Yeah, absolutely. And the very last thing on that is, on the way up, as in when central banks were raising rates, remember that no one really could tell us where neutral was. The neutral rate is not something where you go, oh, it's 3%. It's an estimate. It's a guess. No one really knows where it is. It's a range. And that's going to be the same thing on the way down as well. So when policymakers were saying we want to get rates into restrictive territory, it's a guessing game as to what defines restrictive. When policymakers say we want to get rates back to neutral, again, it's a bit of a guessing game because no one really knows where neutral is. But anyway, we could talk about that all day. We should probably move on to our fourth topic, because if you couldn't have guessed by now, Ryan's been on a little trip, hasn't he?
Yes, I have. And, well, it's a weird one, because just before going away, I realised I actually had a flat book. I didn't have a single trade on. Everything was done and dusted. That's probably the first time that's happened in about 2 to 3 years. And I often trade longer term, and I try and trade the trend. So, you know, I've always got a finger in a pie somewhere, skin in the game. And when I take breaks, it's not really a problem because I'm trading longer term. I'm not worried about the everyday noise, what might happen, you know, while I'm away. But this time it was weird being absolutely flat. And it reminds me that you don't have to trade every single trade. You don't have to take every single trade. I was more relaxed than normal going away. You know, the beers helped, obviously, but not having to look at my phone every 10 minutes helped as well. I think it's important for traders to try and pick and choose their trades. So you're not trading too much, and you are taking a break if there's no trades to be had. Exercising patience, waiting for those trades you feel have the best chance of success. You know, we can all draw lines on the charts. You know, Mike's taken up that as well. You know, we see some nice, decent charts from him. You know, we can always find levels on charts to trade. But you need to be selective with trades. You know, which ones you trade. Have a look, judge them, give them a merit. Say, right, well, I've got 5 levels here. Which one would I really have conviction in trading? But it's also okay not to put on a trade. If you look at your levels, if you don't have a conviction and you think, well, yeah, I might trade that, I might not trade that. If you haven't got that great conviction, leave it alone. There's nothing wrong with being flat. There's nothing wrong with waiting for that trade to come along where you think, yep, that's the one I want to do. Because I think one of the things traders do wrong is they overtrade. They want to try and get every trade. And, you know, if that doesn't work, you then start to build up losses. And even if they're small losses, they soon mount up. So, you know, if you're not going to be around to monitor your trades, don't think, well, I'm going to get in a trade for a quick 20 pips, but I've got to go down and pick the kids up for school, or I've got to go to work, so I'm just going to leave it to my stop. I'm not going to be in front of my computer. You know, maybe think twice about taking that trade, because if you're not there to watch it, you can't act on it. And if you find you are taking too many trades and they are losing, might be time to have a pause and be more choosy about the trades you take. And if you need to take a break for a while and let the book go flat, then that's something you need to look at.
No, absolutely. I think that's really, really important advice, whether you are day one trader or year 20 trader. I think, speaking personally, we're all guilty of not taking a break. We're all guilty of staying plugged in when we're meant to be away, or, making stupid decisions when our mind is not quite in the zone where it should be. And I think that's even more important in a week like this. We've got event risk left, right, and center. Every couple of hours there is a key event on the calendar that if you're not at your screens, you could fall foul of that by not monitoring that trade properly. And if you are in a position where you do find yourself over trading, not only of course do you have that risk of loss, but also think of the trading costs you're going to incur just by doing that as well. And I think it's really a case of less is more at the end of the day with this game.
Yeah, the idea is obviously to stay in the game. And, like you say, these weeks can be very dangerous because traders look at it and think, we've got all these central banks, all this data is going to be big market moves. Well, yeah, you can make a lot of money in there, but you can also lose a lot of money on that volatility. And I say to a lot of inexperienced traders, if you're not sure, stay out, look at where things were going into all these events, look at where we are after, and then look for the opportunities. Are there any anomalies in the price moves? Has something moved out of sync with where it was before? And those are the opportunities you can look at after all these events are over and you know what we're doing.
Yeah, absolutely. And that's something that I know our mutual friend Mike Patterson does very well indeed. An event comes out, let the dust settle, let the market go where it wants to. And then if you think it's gone far, choose whether you fade the move if it's got to one of your levels. If it's gone the way you think it has, do you think it's going to continue? Has it broken a support or resistance level? Do you jump on that trade? But don't rush into something just because a bit of news drops. You think, oh my word, I've got to do something. That's not the way this works. In any case, let's move on to some charts in That's a Setup. I was close to making a joke about West Ham fans and police sirens then, but I think you were all relatively well behaved this week, weren't you?
We're always well behaved, always well behaved.
Of course. Now, if you couldn't have guessed, both Ryan and I have got a background in FX, judging by the charts that we've selected this week. And I assure you, we do not confer before we put this together. But anyway, Aussie CAD is what I want to look at first of all. And the reason why I want to look at this is because both the Reserve Bank of Australia and the Bank of Canada surprised, quote unquote, with 25 basis point hikes last week. Now, of course, if you were watching the show last week, I think both Ryan and I said that the chances of those moves, at least that the market was pricing in, seemed too low. And so it proved. But I think what's interesting looking at this chart and the way that price has traded since is that the market seems to believe the tightening bias from one more than it does from the other, given where we've moved here. Now, of course, we didn't have great jobs data out of Canada on Friday, employment falling, unemployment rising, earnings a little bit soggy as well. So that's not going to have helped things particularly much. But I think the way that the market has moved through what was pretty stiff resistance at 89.55 and closed north of the 50-day moving average on Friday, to me, that says that the market is actually believing the Reserve Bank of Australia a little bit more than it is believing the Bank of Canada in terms of being able to raise rates further into restrictive territory. And of course, the other thing to consider is the respective drivers of the currency. The Aussie dollar traditionally has a very, very close correlation with risk assets, with the S&P 500, which of course had a fourth straight weekly gain last week. The Canadian dollar, meanwhile, has quite a close relationship with crude oil, and crude again sliding, Saudi's output cuts really failing to prop up the price. And I think if we do see this continue to move higher, you would obviously look towards the 200-day moving average at 90.40. 89.55 stands as pretty solid support below. But I think it's just a nice way of illustrating that although both central banks did the same thing last week in terms of rates and said pretty much the same thing in terms of guidance, the market is not interpreting both in exactly the same way.
Yeah, this one looks a definite one of those trend is your friend charts. We had that bottom down at the end of May and it's been uphill ever since. And until we start to break that the other way, then, this is going to continue. You're right, the RBA has helped it along a little bit. commodities as well. Oil, as you say, for the CAD side, which, you know, I'm not surprised to see that gap we got in oil last week faded pretty quickly. So that's a bit of a anti-CAD move as well. I think your levels look pretty solid. You know, we're holding above this 89.55. While we do that, the upside beckons. You know, there's no reason why we don't get a move up to that 91.05 level you've got there. And that's going to be a solid move for the pair, and probably a solid level to think about taking profit or maybe trying a cheeky short.
Yeah, absolutely. I think that is the level to watch if we can extend gains. What about dollar yen with the BOJ on deck this week?
Yeah, well, it's having a little pause at the moment after its grind up from 130. The uptrend, again, in this one remains in place because pullbacks have been very shallow and hoovered up quickly. The CPI, FOMC, obviously may be the key to unlock a decent move one way or another. But we always have to be ready with our levels. And the main range right now is 138, 141. Those are the big areas to watch. We're pretty much bang in the middle of those. So it really is a bit of a coin flip from here. Now, dollar yen is my go-to pair for trading the Fed and most big, you know, US data points. But it's important to know how a pair functions, you know, its moods, its character, because a lot of pairs have different characters. And we also need to keep in mind this is the Bank of Japan too. So with this one, we had the period the last few weeks where it just keeps grinding. Doesn't seem to do an awful lot, but it just keeps going in one direction. And in this case, it was higher. And we've moved up, you know, fairly significantly, but it's been a slow process. Now we're seeing a bit of consolidation. So we have perhaps over these events a chance to test one side or the other of this big range. And those will define, for me at least, the trading opportunities if we get a test. Can we break them or will we hold them? And I love it when we get these well-defined ranges and levels to trade because it makes things simple. You've got one number, it's either going to hold it or it's either going to break it. So the range is going to be my marker for the events this week, and whether we're going to go somewhere new or whether we're staying where we are and just going to trade between the goalposts, as we say.
Yeah, absolutely. As you rightly say, the range is very, very well defined here. What I think is interesting, just looking at dollar yen was flat to marginally lower last week, you know, 0.4 but 2-year treasury sold off about 10 or 11 basis points. And of course, you usually have that positive correlation between where dollar yen goes and where treasury yields go. And the fact that just broke down a little bit last week does perhaps put a little bit of doubt in my mind as to whether, you know, if we do see, you know, is one going to catch up to the other? If we get a cooler than expected CPI number, yields would obviously fall, you would expect. Can dollar yen fall as a result of that? Or are we starting to see, given the perhaps idiosyncratic risks around the BOJ a little bit later on this week, are we starting to see that relationship just soften a little bit compared to where it has been? So I think that's another factor worth throwing into the mix. But as you say, the levels here are very, very well defined and you can play it from either side, really. Yeah,
exactly. And you've got to be careful, again, going into the Bank of Japan. You know, let's say we're knocking up at that 141 level and we haven't broken it into the BOJ. You've got to be a bit careful on that because if they're not, you know, don't give us anything hawkish, then we're likely to break 141 and that's going to be the move that's going to continue for a bit and maybe move us out this range.
Yes. The other thing, very last thing I'm going to say on the Bank of Japan is they don't give us a set time for their announcement. You know, this era of central bank transparency doesn't seem to have quite made it over to Japan just yet. And the general rule of thumb is the longer into the morning it goes without the BOJ having said anything, the more likely it is that they are actually going to do something and announce some sort of policy shift. And it's important bearing that in mind because every trader who is trading the yen knows that and thinks that. And as a result, there is a bit of a tendency for the market to perhaps just front run and expect something from the BOJ the longer time goes on. And then, of course, it could go one of two ways. If they do what the market has been front running, then the move may be a little bit less than you'd be expecting. If they don't, of course, you're going to see all of that unwind. And then the market would react to whether it was a dovish or hawkish surprise. So just something else to bear in mind if you're trading the yen over the BOJ.
Yeah, absolutely. And this is only UEDA's second meeting, and he kept us waiting at the last one because I got up for it, and he made us wait and wait and wait, and I could have got an extra hour skip.
Well, I certainly don't plan on getting up early for the BOJ on Friday morning. Anyway, let's get on to cable. I want to talk about the pound very quickly. I think everyone knows at this point that I'm bearish on sterling. I am slightly worried about getting a bit married to this view at this point, given that sterling does seem to be defying expectations at this point and closing north of 125 and at a 4-week high, basically a 1-month high on Friday. That is despite all of the poor data that we've got coming in. The PMIs weren't exactly great. Inflation remains far too high. The BOE remain incompetent, etc., etc., etc. We know all of this at this point. 125.85 is the level that I'm watching like a hawk at this point. If we break north of it, then we could obviously, and close north of it importantly, then we may get back towards the April highs just shy of 127. But I think, again, we're probably going to see sterling run out of a little bit of steam here. You've got labour market data due Tuesday morning. It'll probably be out by the time this show airs, but expectations are for conditions in the jobs market to continue deteriorating. I'd argue the balance of risks points to the Fed being more hawkish than the market is pricing in on Wednesday evening. So that's obviously potentially dollar bullish, bearish for cable. And personally, I wouldn't really mind selling into the rally here. If you look at the chart, when cable's got north of 125 of late, it does seem to get a little bit scared and like to get back below 125 in relatively short order. But as I said, sterling has defied my expectations for some time now. Will it continue to do so? We will wait and see. But I just can't bring myself to like the pound at this point.
And that's the funny thing, because you have been bearish for quite a while, and it's done nothing but go up, and that tends to suck a lot of people in because a lot of
maybe if I flip my view, we'll see the pound come lower.
Well, so that's why you trade with your head and not with your heart.
Exactly.
A lot of people are always perma bearish for the pound, and this is one of those times where we could end the week. It could be at 130 or it could be at 120. It really depends on what happens with all these data points and the Fed and everything else. But we have got the Bank of England coming up. And, if the Fed pause and if they sound a bit dovish, we're probably going to bust that high in a blink. And as I say, we might be on for a move for 130. Conversely, if we don't, then I still think the Bank of England are going to be coming out more hawkish than, the market is expecting them to be a bit more hawkish now. And then if that gets confirmed, again, there's upside. So when you add it all up and think, well, how many reasons have I got for the pound to go up? They far outweigh the reasons for the pound to go down. And sometimes that's all the bias you need in trading to know, right, well, if I'm going to fight this move, I need to be a little bit tighter in my stops. I need to be a little bit smaller in my position sizes because I'm fighting a very strong wind. On the other side, if you get the dips and you want to get in on the long side, that's what you do. Wait for a decent dip and get in and then see where it wants to go after that.
No, absolutely. What about looking down under at the Aussie dollar?
Yeah, looking down under, and a bit of a similar picture to what you showed with Aussie CAD. And sometimes I like this pair for how it plays technically. It can move lower or it can make a big move, and it just seems to keep going and keep going and keep going, and then you get very weak bounces if it's going down. And I always say to traders, you need to look for those signs of when something's bottom. We've got lows all the way down, and people can play at those lows, but then you get a point where you break an area of prior technical traffic, let's call it that. So we've had a blue zone down there, which has been a prior support and resistance slot. And we've broken through there, but then we've come back above, and then we find it as support again. So those are signals you're looking for when you want to get a rebound of any sort of move. And it's pushed on, and the data's helped on the US side. We had some weaker data. The RBA obviously being a bit more hawkish and going with a surprise hike. And the trend, again, even in the short term, is higher. Now, we've had a move up. It's got back up through all the technical levels. We've got a big one coming up in the 68s. It starts from the big figure. We had previous resistance there when we had that move down off the prior highs. That's where we held. We're coming up to that level again. So if you're long from the bottom, that's the area you want to be looking at to maybe take some profits. If you're looking at shorts, that's the level you want to be looking at, because if it holds on a first test, maybe you're going to get a pullback from 68 maybe to 67s, see what it wants to do after that. But if we get above that 68 area, we're probably heading to 70, and this move's going to continue, and it's going to eat away at that drop that we saw in the early part of the year. So for now, go with the trend. This is probably one you want to play buying off dips, but watch it into that 68 area. That's going to be the biggie from here.
Yeah, I think you're right. And actually, as you say, a lot of charts are starting to look a little bit similar. We're in a trend and we're getting close to a relatively key level. You look at cable at 125.85 or even above 26.80. The Aussie dollar getting very close, as you can see on the chart, really well-defined top of the recent range at the 68 figure. And then you obviously start to ask yourself, is this not only a make or break week from the point of view of the economic data and the central bank decisions that we got coming out, but also from the point of view of the charts. We're at very, very key levels in a number of G10 pairs. We could start to be seeing signs that, the the bullish dollar trend that's been in place, is that starting to turn a little bit? Will the Fed, cooler than expected CPI give that a little bit of a helping hand? But I think certainly looking at here, as long as we are in this uptrend and making higher highs, I'd be buying dips into that 68 handle all day long.
Yeah, exactly. The trend is your friend. We don't have that saying for no reason.
Exactly that. Well, let's get on to our plays of the day, because the trend is hopefully going to be my friend there as well. Those titles ended quicker than I expected. In any case, the S&P 500, it's boring. I've used this chart quite a lot at this point, but it's working. So why would I stop doing it until it stops working even? The market just continues to climb this wall of worry. There's plenty that keeps getting thrown at the market. The Treasury General Account rebuild, the whole pause, pivot, skip thing with the Fed, the economy slowing down, particularly the manufacturing sector, signs that inflation is becoming a little bit stickier, unemployment rising, albeit from a very, very low level. But equities are just kind of shrugging their shoulder and going, okay, fine. We don't care. We're going to continue rallying. The S&P 500 back into a bull market last week. I'll probably get told off for this, but going back to 1950, after the S&P entered a bull market, it has continued to gain 9 out of 10 times over the following 12 months. Why would this time be different? I can't really find a convincing argument for why it would be. And of course, the other thing to remember is looking at volatility. The VIX is at its lowest level since February of 2020, which is, of course, before the pandemic. And again, that makes playing this from the short side very, very difficult. Of course, there's risk on the horizon this week. US inflation and of course, the Fed meeting are the major two. But I think for me, if we do get any dips in risk assets, in equities in particular, on those meetings, I would be buying into them as long as we're above 4,200, and actually as long as we're above the 50-day moving average, that pink line there, which you can see has provided support to the rally and a helping hand through March and April and into May as well. I would be buying dips in risk assets all day long and staying long on a core position as well. Ryan, what about Euro?
Yeah, well, don't tell me off again when I look at dollar China for 3 weeks on the trot. I think you've had the S&P up for 4, so you're holding the record at the moment. But anyway, yeah, I'm looking at euro dollar this week. I think it's going to be a very decent pay, obviously, through all the events, US CPI, FOMC, ECB. And, it's really double trouble for those two events. I'm looking for the Fed to remain resilient about hiking, even if they decide to pause now. So I really would look to buy a dip in this pair if they hike or if they sound hawkish, then to run into the ECB. Conversely, if we get a break up above 108 on something dovish, that's another way to play it, and on a break long, again, over the Fed to run into the ECB. What you want to try and do is get some margin in this trade to trade into the ECB, so you can lock in some profit, take some counters off the table, and move the rest up with stops. But levels wise, I'm just speaking about the Aussie. This is one where we came off that 111 high, we had a move down, one-way traffic, got down to those lows in the 106s. Then we bounced, then we had a pullback. It didn't quite get to those lows, so the price action showed we may be building a bit of a bottom here. So I'm going to be looking to lean on those lows down there, maybe into 107, a bit lower, and ride some longs into the ECB.
Long euro. Ryan will now be going to wash his mouth out with soapy water before he comes back on the show next week. That does bring us to the end of this week's show. Thank you very much to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, as always. Thank you also to our producer, Kyriakos, not for the background, but for bringing this together as brilliantly as he always does. If you've enjoyed the show, please leave a like on the video, drop a comment as well. Let us know how you're trading the markets. It is, of course, an absolute monster week ahead, and all three of us will be back this time next week to chew the fat over what happened and also look ahead to, I think we've got a Bank of England decision next Thursday, which I'm sure both of us are already excited for. So thank you very much as always for watching, and we'll see you again next week. Goodbye for now.